Hey everyone, welcome to another Tax Tip Tuesday on this great February 11th. My name is Rose Brown, also known as the Accountant Therapist, and today we're talking about the Earned Income Tax Credit. Now, this is a credit where a lot of people would love to be eligible for, but unfortunately, it's so strict in terms of the criteria that must be fulfilled in order for you to be eligible that a lot of people just fall out of that, right? So we're going to be talking about the ins and outs concerning the Earned Income Tax Credit today. With that being said, I am the CEO of Brown's Advisory and Accounting Firm, and we provide an array of accounting services, including taxes for both individuals and businesses, planning, preparation, advisory, you name it, anything taxes, we deal with those, right? And if you're ever in need of an initial free consultation, you can certainly reach out through our website at info@brownsfca.com, or you can send us an email at info@brownsaaf.com. Wow. Now, just to do a quick recap of last week, we talked about the tax impact of being self-employed. Now, when you're self-employed, you want to make sure that you fully understand what it means to be, self-employed from a tax perspective. A lot of folks become self-employed and the taxes literally hit them over their head. So if you've not yet seen that video, definitely check it out. And again, if you have questions, I'm here. Let me know, okay? All right, so let's jump into today's topic. And I do have some figures that I want to share with you, because when it comes down to a lot of numbers, I want people to see it so that they can fully understand what's taking place. So as we talk about the Earned Income Tax Credit, it's important to understand what it is, right? The good thing is the name itself kind of gives it away, right? In order for this to be a credit that's accessible to you, you have to have earned income, all right? So the Earned Income Tax Credit. And what that looks like is you are providing your services and being compensated. You've worked for it, right? So that means if you just have portfolio income like stocks, you wouldn't be eligible for this. Or if you just had rental activities, long-term rental activities, you won't be eligible for this. So you have to have earned income. Okay. Now, this is a credit that is geared towards those who are within the low to moderate income bracket, right? Now, what that also looks like is not only do you have to have low income, you also have to fulfill a couple of other criteria. And that also means you must be a U.S. resident or a citizen, and you have to have a valid social security number on your tax return, and you must be a full year resident. So you want to make sure all of these things are in place in order for you to be eligible. What that also means is if you're filing your own tax return or if someone's assisting you, you want to make sure that, hey, I'm not illegally being eligible for this credit, right? Now, in terms of the social security number that I mentioned earlier, every person that's listed on that tax return needs to have an eligible social security number. Okay, but the good news about this credit here is that it's fully refundable, and that's why it's so strict. It's one of the few credits that are fully refundable, and what that means is if you are eligible for this credit, you could receive the entire amount in the form of a refund, right? So it can increase your refund or reduce your tax liability. So if you're eligible for it, you can potentially expect to get a refund from it. Okay. Now it ranges from what the amount looks like in terms of the lowest credit available versus the highest. And we're going to touch on that a little bit later. Now, a lot of people may say, okay, you've explained what it is, who's eligible, like, am I eligible? Right? So let's talk about that. Now, you don't have to have a dependent in order to be eligible for this credit, which is a pretty good thing, right? But you must be eligible. Okay, and it's going to take into consideration your age. It's going to take into consideration your filing status. So a couple of weeks ago, I talked about filing statuses, right? But first and foremost, if you are over a certain age, right, or a certain amount of income, you must have a qualified dependent on your tax return, right? So the more dependents or qualified dependents you have in your tax return, it helps you to boost that eligibility for that credit. Right? Now, if you don't have a child, you must be under a certain age in order to be eligible, right? Now, no one else can claim you on their tax return if you are seeking to claim this credit on your tax return. So what that means is Maybe you're in college and your mom normally claims you on her tax return. If she's claiming you and you go to file your tax return, if she's claiming you, you can't claim the earned income tax credit on your tax return, unfortunately, right? So it's one of those things where you want to make sure that you're being strategic when it comes down to this credit, but also making sure that you're actually eligible, because compliance for this credit is huge, really, because it's a refundable credit that honestly you can get up to $7,000 from this particular credit. So of course, as the IRS is issuing out money, it's going to cause them to ask questions if they feel the need to. Okay, let's leave it at that, if they feel the need to. Now, the person that's filing a tax return, again, they have to have earned income, right? So even if they are doing a joint return, at least one person needs to have that earned income on their tax return. Now, when we talk about dependents that are eligible, you want to make sure, again, your dependents, first and first, is this your child by birth, adopted child. They're eligible for you to be considered for the earned income tax credit. Is it your step child, your foster child, your sibling, your niece, or your nephew? Yes, any one of those individuals could cause you to be eligible for this particular credit here. Now, the child, however, must be under the age of 19 at the end of the year, or under 24 if they're a full-time student. Right, so you can see as I'm going through it, there's a lot of different stipulations that are in place that you must acknowledge and ensure that you are eligible based on that information. Now, the child, again, must have lived in the US in the last year for the entire year, right? More than half of the year, they have to be living in the US. And of course, you need to be providing for their needs as well, all right? Now, we just talked about folks who are eligible, whether you're the filer or you're the dependent, okay? Now, if we were to flip that script there and we're looking at folks who are ineligible, a couple of things you want to kind of keep in mind, right? So if you are reporting foreign income on your tax return, it may cause you to be ineligible, okay? If you are someone who, if someone is claiming you, as I mentioned earlier, you will be ineligible for this particular credit. If you are using the married filing separate status, a couple of things to keep in mind here. Now, the married filing separate doesn't disqualify you all the way, right? If you're able to kind of check off a couple of boxes. That means, hey, were you living with your spouse for the last 6 months of the year? Do you have a dependent? How old are you? So a lot of different things are coming into play when you are married filing separate. And again, it's one of those filing statuses that it has a lot of disadvantages to it. Okay, now another piece to note, if you are desiring to claim this credit here, you cannot have investment income of more than $11,600 for 2024. And this number here, along with the other numbers that I'll discuss later on, they increase according to inflation, right? So every year these numbers increase, fortunately, right? Now, with regards to the credit amount, it is affected by the income that you earn, right? So if you make too much, you're not eligible for it. I won't say if you make too little, you won't be, because that brings you to that place of probably most likely getting that full maximum of that credit, right? So the amount of income that you bring in and the number of qualifying dependents that you have on your tax return is going to determine the amount of credit that you're eligible for. Now, for 2024, the credit ranged from $632 to $7,830. So again, it can be very high depending on your income as well as the number of qualifying dependents that you have. So what I'm going to do here, just go ahead and share my screen so you can kind of see what I'm referring to over here, right? So as we see this document here, right? So if you are a person filing single, head of household, and you have, well, if you are single and you have no dependent, the maximum credit that you're eligible for is $632 in 2024, for 2024. What this also means is if you make above this amount here that's listed, this $18,591, if you make above that amount, the credit begins to phase out. And what I mean by phase out is it becomes less than what that maximum amount is until you are no longer eligible for the credit because you make too much, right? And you can see there, if you have one child and you're filing head of household, you have that $49,084 has to be your maximum income in order for you to get that maximum credit of $4,213. Again, the more you make, the more you phase out and then become no longer eligible for this credit, right? Married filing joint, because it's two folks put together, the income is a little bit higher. So you want to kind of keep that in mind there, right? Now, you'll have this to kind of look at a little later so that you can kind of have reference. And the IRS they do have a calculator online where you can check to see if you're eligible. So again, if you are filing your own tax return or you're going to someone and you just want to kind of make sure, you can certainly use the IRS's worksheet, if you will, to determine if you're eligible before you even start filing your tax return. Okay. Now, a couple of things to keep in mind. Tax returns that include this particular credit here, by law, they cannot, if you are a person who are claiming this credit on your tax return, by law, the IRS cannot release the refund until after February 15th, right? So generally, refunds that are attached to the earned income tax credit aren't received until most likely the end of the month of February. Okay, so again, if you've already, let's say you filed your tax return last week and you're expecting your refund, they can't release the refund until after February 15th. Okay, so if you are checking the IRS's website, where's my refund, and you're not seeing your refund pop up or any status, this is the reason why. Okay, now if you, and this piece here is very critical for you to be aware of. If you have claimed this credit incorrectly, you can be banned by the IRS from claiming this credit for 2 years or even as much as 10 years if you fraudulently claim this credit, right? As I mentioned earlier, with this credit, it is fully refundable, which means if you are someone who's eligible for that $7,000 in refund, you're getting that in the form of cash, right? It's being direct deposited in your account. You're receiving a check, anything of that sort. That's the IRS giving you money. And whenever they're given money, they want to know that, hey, this person is actually eligible for it. So even as tax professionals, we have to complete what is referred to as due diligence, right? We have to vet the client and ask them all these questions concerning their prior activities. And sometimes it may seem a little invasive, but this is what needs to be done so that the IRS can pretty much check off, hey, yes, this person is absolutely eligible for this credit here. So these are the things you want to keep in mind concerning the earned income tax credit. Understanding that you have to have earned income to be eligible for it. Understanding that you do need to have a social security number on the tax return for all persons that's on the tax return. Your residency needs to be in the US, right? So all these different things you want to kind of keep in mind. If you have foreign activities, it may cause you to be ineligible for the credit. If someone is claiming you on their tax return, it will cause you to be ineligible for the credit. Okay, so that's pretty much it for this week. I know we're short, sweet, to the point, but that's just how the earned income tax credit works. Ensure that if you have a child, somebody you know have a child, share this with them so that they can understand the impact, and especially because the year just passed 2024, right, which is what we're filing in 2025, they'll be able to see the figures and what things could potentially look like on their tax return. With that being said, my name is Rose Brown, also known as the Accountant Therapist, and I will see you all next week for another Tax Tip Tuesday.